The dot-com bubble. This is the story of how the internet convinced an entire generation that the old rules no longer applied. And of what happened when they turned out to be catastrophically wrong about everything except the internet. March 10, 2000. The Nasdaq Composite closes at 5,048, an all-time high that no one will touch again for 15 years. No bell rings at the top. No warning is sent. It just quietly, almost imperceptibly, begins to fall. What followed was 929 consecutive days of selling. From 5,048 all the way down to 1,114. A loss of 78% and not a single durable bottom in sight. $5 trillion in market value, erased. There was no explosion, no war, no external shock anyone could point to. Just a line on a chart moving in the wrong direction, day after day, until the money simply ceased to exist. Behind that chart were millions of ordinary Americans, nurses, teachers, retirees, who had done exactly what the experts told them to do: put their retirement savings into technology stocks. Because everyone, from the financial press to the neighbor next door, was saying the same thing. It was not different this time. Take Pets.com, which sold pet food online and whose mascot was a sock puppet. In the year it went public, the company generated $619,000 in revenue and posted losses of $61 million. Every single order shipped cost more to deliver than the customer paid for it. And yet, in February 2000, Pets.com spent $11 million on a Super Bowl advertisement to sell dog food at a loss per transaction. And yet Wall Street valued Pets.com at $290 million on the day it went public. Analysts issued buy ratings. The public bought in. No one, it appeared, had thought to ask a very basic question about the business model. 9 months later, Pets.com was gone. The sock puppet mascot was auctioned off for parts. But here is the thing about Pets.com. It was not an exception. It was the rule. To understand how any of this was possible, how a company that lost money on every single transaction could be worth hundreds of millions of dollars, you have to go back 6 years, to 1994. 1994, Netscape releases the first commercial web browser, and for the first time, ordinary people can actually see the internet. It doesn't look like much yet. But something enormous has just. Silicon Valley notices almost immediately. Venture capital starts flowing into anything with a .com in the name, not because the business models are proven, but because being too slow to invest suddenly feels riskier than being wrong. The logic, at least, was internally consistent. The internet would change everything. Whoever got big first would capture the market. Profits could wait, because once you owned the category, profits, a new vocabulary emerged to replace the old metrics. Not profits, but eyeballs. Not revenue, but click-through rates. Not sustainability, but burn rate, which somehow became a badge of ambition rather than a warning sign. In December 1996, Federal Reserve Chairman Alan Greenspan delivered a speech that would later appear in every textbook on financial bubbles. He used the phrase irrational exuberance, a warning. From the highest financial office in the country, that asset prices had become untethered from reality. The Dow fell 2% on the news. By the following morning, it had recovered all of it. Greenspan did not raise the alarm publicly again. The party, having barely paused, continued. By 1999, the mania had reached a pitch that made even skeptics question themselves. Qualcomm stock rose 2,619% in a single calendar year. And Qualcomm, unlike most of its peers, actually made something. Meanwhile, something extraordinary was happening outside of Silicon Valley. Ordinary people, dentists in Ohio, teachers in New Jersey, retirees in Florida, were quitting their jobs to trade stocks full-time, chasing the kind of returns that had previously been the exclusive domain of hedge funds. Venture capitalists repeated the same phrase, in pitch meetings and on television and in the pages of business magazines. Old economy rules don't apply here. This time, it is genuinely different. Between 1999 and the end of 2000, 457 technology companies went public, effectively an IPO every single business day for nearly 2 years. The majority had never turned a profit. Many had barely generated any revenue at all. A handful of analysts did raise uncomfortable questions about cash flow and business models with no credible path to profitability. They were not taken seriously. In the euphoria of the late 90s, skepticism was not a credential, it was a liability. Over $100 billion in venture capital flooded into internet companies across those 5 years. And at the peak of the bubble, the question of where it would all end was not, for most people, a question they were asking at all. Here is exactly how it worked. A startup raises capital from venture investors. It files for an IPO. The stock pops on day one. The insiders get rich. And what was actually happening behind the scenes was this. Investment banks set the IPO price deliberately low enough to guarantee a first-day pop. The stock doubles. The press calls it a triumph. The bank collects its underwriting fee and immediately moves on to the next deal. In November 1998, the Globe.com surged 606% on its first day of trading. It was a social networking site. In 1998. But here is where it becomes more troubling. The analysts at these same investment banks, the ones structuring and selling the IPOs, were simultaneously issuing buy ratings on the very same stocks. The firm that took the company public was also telling the public to buy it. This was not, at the time, considered a conflict of interest. And then, in January 2000, AOL announced a merger with Time Warner for $165 billion. The deal of the century, they called it. The largest corporate merger in history, sealed at the exact top of the market. What Time Warner failed to examine too carefully was that AOL's entire currency was its own wildly inflated stock. The moment the bubble began to deflate, the deal's value would collapse. Shareholders would eventually lose $200 billion. The chief executive of Time Warner later described it, publicly, as the worst deal of the 20th century. It wasn't only internet companies. Webvan promised to deliver groceries to your door in 30 minutes and raise $375 million to build the infrastructure. To do it, enormous automated warehouses in 26 cities. They then discovered that every delivery cost more to execute than the customer actually paid. The more customers Webvan acquired, the faster the money burned. The company went bankrupt exactly 2 years after its IPO, as though it had scheduled its own collapse. What ultimately lit the fuse was not a scandal or a fraud. It was interest rates. In June 1999, the Federal Reserve began raising them 6 separate hikes over the following year, and the cheap money that had been fueling the entire enterprise began, quietly, to disappear. Companies that had been rolling over cheap debt to fund their operations suddenly could not refinance. And without continuous access to new capital. The business model that most dot-coms had been operating on, is spend now, figure out revenue later, simply did not function. In March 2000, Barron's magazine published a piece called Burning Up. The analysis was methodical and devastating. At their current rate of cash consumption, 207 dot-com companies would be completely out of money within the next 12 months. The article was, in the end, conservative. 3 days after the peak, on March 13th, the Nasdaq fell 9% in a single session. Not a correction. Not a buying opportunity. The selling compounded. Investors who had borrowed money to amplify their gains received margin calls, forced demands to either deposit more cash or liquidate their positions immediately. They sold. Which drove prices lower. Which triggered more margin calls. Which forced more selling. A feedback loop with no natural floor. Even Amazon, a company with genuine customers, genuine revenue, and a genuine future, fell 95%. From $107 to $5.51 a share. It survived because it had the reserves to outlast the carnage. Most companies didn't have that option. When it ended, the question was the same one it always is after a financial collapse. Who actually, $5 trillion in market value, destroyed? And the majority of it belonged to people who had nothing whatsoever to do with Silicon Valley. Pension funds and retirement accounts had rotated heavily into technology equities at exactly the wrong moment. Ordinary workers who had spent 30 years saving and who had simply followed the conventional wisdom of the era watched it evaporate in 18 months. The venture capitalists, meanwhile, had structured their positions precisely so they could sell at the IPO. They were already out. The investment banks had collected their underwriting fees before the first share ever traded on the open market. They were already out, too. Insiders, executives, and early employees were subject to lockup periods that prevented selling for the first 180 days after the IPO. After that, the restrictions expired. They sold, quietly and in volume. Publicly, most of them continued to express confidence in the company. The number of dot-com executives who faced criminal charges for the collapse? 0. Several were raising money for their next venture within months. The structures that had allowed all of this had not been illegal. Merely catastrophic. A small number of companies did survive and would go on to become some of the most valuable businesses in history. Amazon, eBay, PayPal, and Google, which hadn't even gone public yet, quietly building something that actually had a revenue model. What distinguished the survivors wasn't the vision, the technology, or even the founders. It was something more fundamental. At some point in their development, someone had asked the question, how does this actually make money? And had received and acted on a real answer. Google waited until 2004 to go public. By then it had a real business model, real advertisers, and $1.5 billion in annual revenue. It was, in that respect, almost aggressively. The Nasdaq Composite did not recover its March 2000 peak until April 2015. Not 2 years, not 5, 15 years. An entire generation of investors who had bought at the top and held on were still underwater a decade and a half later. As for the dentist from Ohio who had quit his practice to trade stocks full-time, he went back to dentistry. If, after everything, he was still in a position to. Today, a new generation of technology companies are raising billions of dollars on the promise that profitability can wait. That scale must come first, and the economics will follow. That this time, the old rules genuinely don't apply. And the experts, once again, are saying it is different this time. This is a finance channel. We do not editorialize. That is just what happened.